Random walk debunked. Best trading days come after the worst. And one easy rule to beat the market. Imagine checking your investments after a brutal market crash like during COVID with the March 16th to 20th, 2020 minus 18% week. Your balance is down 32% and panic sets in. But what if I told you the biggest rebounds, like the 12% surge the very next week, almost always follow? This isn't luck. It's a pattern that makes stocks more predictable and rewarding than the random walk myth suggests. The average investor saving for retirement, understanding this could mean thousands more in your pocket annually without switching to boring bonds. Just change your outlook and use a simple method to beat the market. All right, in this post, you're going to learn what is the random walk theory, why is the stock market not a random walk, how can you use this to your advantage, and an easy way to beat the market. So what is the random walk theory? So the random walk theory is a financial theory that states stock prices move based on random walk, meaning changes in prices are random, unpredictable, and independent of past movements. It's like flipping a coin where today's market prices movement is unrelated to yesterday's or tomorrow's. Increases and decreases in value in any time period are purely random. It's closely related to the efficient market hypothesis that states that stock prices fully reflect all available information at any given time, so the current price of every stock is the true value. The key idea of the two theories is that the future price movements cannot be reliably predicted using historical data, patterns, or analysis because new information arrives randomly and is quickly incorporated into prices. This implies it's impossible to consistently outperform the market through stock picking, timing, or technical fundamental analysis. Any success is due to luck, not skill. Now, if this was true, then no investor or fund manager would outperform the index except by luck. Fundamental analysis would not work. It's analyzing a company's financial statements, management, industry conditions, economic factors, and intrinsic value, like earnings, revenue, and assets, to determine if a stock is undervalued or overvalued. Technical analysis would not work. Technical analysis is studying past market data, primarily price charts, volume, patterns, indicators like moving averages, assuming that historical trends and investor psychology repeat. Also means market timing and stock picking would be futile, and the current price of every stock is the true value even during market crashes and bubbles. Now, why is the stock market not a random walk? The random walk theory states stock market results are purely random. They're like a coin flip and unaffected by any of the results before or after. It's like a drunk stumbling down the street. For example, if you have a coin that just flipped heads 10 times in a row, the next flip is still a 50-50 chance of heads or tails. However, the stock market is not like that. With the stock market, big crashes are usually followed immediately by explosive rebounds. The largest losses and largest gains are usually right after each other. So here are the biggest gains and losses for day, week, month, year, and decade. The last 100 years. So the worst day was March 16th, 1930, a 12% drop in one day. But the March 24th, the second best day ever, was a week later, 9.4% gain. The worst week ever, March 16th to 20th, 2020, 18% drop. The very next week, March 23 to 27 of 2020, 12% gain. The worst month on record was October 2029, a 26.5% drop in 1 month. But the third best month on record was the very next month, November 1929, to 10% gain. The worst year on record was 1931, 47% loss in 1 year. But the best year on record is 1933, just 2 years later, 54%. Yes, the 54% in the middle of the Great Depression. The worst decade on record is 2000 to 2009, 3.4% per year average loss. But the best decade on recording is the one just before that, 1990 to 99, which was 18.2% per year. So this means The stock market is significantly more reliable than the random walk theory claims. The stock market is also very irrational much of the time. Investors follow trends without logic, what's called herding. They're often overconfident, they overreact to news, become fixated on specific past price, such as their cost, which is called anchoring. They have loss aversion, which means that they tend to hold losers too long and sell winners too soon. And they drive the market into irrational crashes and bubbles. All these irrational behaviors don't fit with the efficient market theory that claims today's stock price is the true value. In his historic book, Stocks for the Long Run, Professor Jeremy Siegel proved that the random walk theory is not accurate for the stock market. He showed the actual standard deviation, that's a statistic for unpredictability, of stocks, bonds, and cash in real life. Compare them to the random walk theory. In this chart from his book, the dashed lines are the random walk. Note that the stock market risk, which is unpredictability, declines much faster than the random walk claims the longer you are invested. The actual standard deviation after 30 years is barely over half of with the random walk. In contrast, the risk of bonds and cash declines much more slowly than the random walk the longer you are invested. For cash, the 30-year risk is more than double what the random walk predicts. So now the reasons for this is that the stock market, big gains tend to be right after big losses. However, bad periods of bonds and cash tend to be followed by more bad periods because they usually result from high inflation, which tends to stick around for a while once it appears. So how can you use this to your advantage? So here's the largest calendar losses of the S&P 500. This is calendar years. Note they all have a large gain either just before or just after. It's not random. So here's the 5 biggest losses of the last 100 years. So 1931 was a loss of 44, but 33, just 2 years later, was a gain of 57%. So then we had 1937 was a loss of 32, but the year before, 1936, was a gain of 33%. So 1974 was another big loss, 27% loss, but the very next year, 75, was a gain of 38%. 2002 was a loss of 22%, but the next year, 2003, was a gain of 29%. And 2008, can't forget that one, a 37% decline. But however, the very next year, 2009, 26% gain. We can use this to assume that any large loss is highly likely to be followed by a large gain. In other words, a large loss, say over 20%, has reliably been a great time to invest. Note that assuming large gains will be followed by a large loss, that's the other way around, does not work. This is because large gains are very common. Large gains are often followed by another large gain. So since 1926, 37% of all years were gains more than 20%. That's 37% of them. Almost 4 out of 10. But only 6% of years were losses of more than 20%. So in short, large losses are rare and almost always followed by large gains. Large gains happen a lot, so you can't use them to predict the future. An easy way to beat the market. The market is not random, and we know large losses are very likely to be followed by a large gain. Here's an easy way to beat the market. Stay fully invested all the time to get a return very similar to the market. Then anytime there's a decline of more than 20%, use it as a buying opportunity. So now if you're fully invested, how can you buy more? Just get creative. There are many ways. For example, you can contribute 2 years worth of contributions in 1 year. You can invest from a small credit line, put in what you can, and then use your annual or monthly contributions just to pay that off. You could start a plan of borrowing to invest. Just get creative and find a way. So there are many ways to invest more if you're creative. The important point is to recognize that it's a good buying opportunity. Note, it's not worth delaying investments to wait for a large loss since they're relatively rare. Only 6% of years have a loss of 20%, which means they average about every 17 years. Now, it's often not that long between them, but usually too long to wait within an investment. Now, this is a simple rule of thumb we have been using for years to get higher returns. Anytime there's a decline of more than 20%, use it as a buying opportunity. For example, on February 10th, 2009, I published a post on this blog, How to Take Advantage of the Market Crash After 2008. The market had just fallen 40% the prior 6 months. Investors dumped their stocks in huge numbers with 35 to 40 billion in net redemptions for the stock market that month. It seems to be normal. People sell at the bottom. However, with our simple rule of thumb, this was obviously a huge buying opportunity. The market ended that year up 26%, even though the first 2 months had been down. Now, similarly, in the COVID crash of March 2020, the market fell 34% in a month. Obviously, buying opportunity, right? So it then essentially recovered in only the next 2 months. So the random walk theory is a myth. If it was true, we would not have a simple rule like this to reliably beat the market. Thanks for listening. What you learned is, what is the random walk theory? Why is the stock market not a random walk? How can you use this to your advantage? And an easy way to beat the market. Thanks for listening. My name is Ed Rempel. My blog is edrempel.com, or it's unconventionalwisdom.ca because we're in Canada. It's the #1 blog in Canada for a full-service financial planner. I also have a YouTube, which is edrempel.com/watch, and edrempel.com/listen is the podcasts on many stations. So if you subscribe to the blog or the YouTube or podcast, all that means is you get my weekly posts by email, and you can watch them when you want to. Thanks for watching, and talk to you next week.